So SoFi absolutely crushed Wall Street consensus this morning.
Mm.
I mean, we are looking at a massive beat across the board for Q2 2026. Record adjusted net revenue hit $1.2 billion, which is up 40% year over year.
Right.
And adjusted EPS came in at 12 cents, just blowing past estimates. Management immediately raised their full year revenue guidance to a tight range of 4.75 to 4.85 billion.
Wow.
Yeah, and the market is reacting exactly how you'd expect. The stock is up significantly in pre-market trading, adding some really heavy momentum to what has already been a pretty volatile year for the sector.
Pretty a volatile year.
So we are bypassing the fluff today to tear straight into this earnings report and the investor presentation for you. The objective is really to figure out if this highly publicized everything app strategy is actually fundamentally sound or, just a temporary sugar high for retail investors.
Well, the initial market reaction is honestly justified when you look at the fundamental durability demonstrated in these top-line numbers. Because hitting $1.2 billion in revenue is a huge milestone. But the anchor of this entire report is really the profitability streak. We are looking at their 11th consecutive profitable quarter.
11 straight quarters.
Yeah, 11. They posted GAAP net income of $157 million. And we aren't talking about adjusted, smoothed out metrics here. That is a clean 13% GAAP margin.
Which is huge.
It is. And then when you zoom out to their adjusted EBITDA, they hit $358 million, which represents a 30% margin.
Okay, wait, I want to stop on that 30% margin for a second because a 44% year-over-year jump in adjusted EBITDA doesn't just, happen by accident in a high interest rate environment.
No, absolutely not.
And alongside that, tangible book value surged 56% to $9.5 billion. Growing tangible book value, which is basically the hard, liquid reality of a company's assets by 56% in 12 months, is just really aggressive for an institution that started as student loan app.
Yeah, it signals a complete transition in their corporate identity, I think. We've watched countless high-growth fintechs, fall into that trap of burning through venture capital to acquire users at a massive loss.
Hoping to figure out the monetization part later.
Exactly. Hoping the math eventually works out. But SoFi is proving they can actually scale efficiently. Maintaining a 30% EBITDA margin while growing revenue at 40% proves that their unit economics are heavily insulated.
Right.
They have essentially graduated from being this cash-burning tech disruptor to a fully capitalized, highly profitable financial institution.
But the mechanics of how they are scaling so efficiently, that is what really caught my eye in the internal metrics. The user data this quarter is just staggering, but it requires a bit of unpacking for you to see why it's driving that 30% margin.
Yeah, let's look at the users.
So they brought in a record 1.1 million new members this quarter alone. That pushes the total member base to 15.8 million, which is a solid 35% growth year over year. But honestly, the member count is almost a distraction compared to the product adoption rate.
Oh, for sure. The product adoption rate is the actual engine of the entire company.
Right, because they added 1.1 million members, but they added 2.2 million new products.
Exactly.
So the total active products on the platform just hit 24.4 million. Product growth is sitting at 42%, which is completely outpacing the 35% member growth. I know we used to use this analogy of a supermarket where more shoppers are walking through the doors and every shopper is putting twice as many items in their cart.
I remember that one.
But that doesn't really capture the financial mechanics at play here. It's actually more like a theme park.
Okay, a theme park.
Yeah. Once a user pays the entry ticket, say, by opening a checking account, every subsequent ride they take, whether that's a personal loan or an investment account, it requires absolutely zero additional marketing spend from the operator.
That is actually a much more accurate framework because SoFi calls this the Financial Services Productivity Loop, or FSPL.
Yeah.
And the metric that totally validates your theme park analogy is the cross-buy rate, which hit 51% this quarter.
51%.
Yeah, that is a massive 16 percentage point jump from last year.
Mm-hmm.
We need to look at how this fundamentally alters their customer acquisition cost.
Because it effectively drives the acquisition cost for secondary products all the way down to zero.
Precisely.
You pay the bounty once,
Yeah.
maybe heavily subsidizing a high-yield savings account just to get the user onto the platform.
Right.
And then the interface itself does all the cross-selling. The offer for a credit card or an auto loan is literally just sitting there on the user's dashboard when they log in to check their balance.
And that is exactly where the margin expansion comes from. Half of all new products being opened right now are coming from people who are already inside the SoFi ecosystem.
Wow.
Yeah. When you remove the customer acquisition cost from a personal loan, the lifetime value of that specific member just goes through the roof. It is a highly leveraged model. And, the more products a user has, the higher the switching costs become.
Oh, absolutely.
Because if your direct deposit, your IRA, and your mortgage are all tied up in one application, the friction required to leave for a competitor is just immense.
It's too much of a headache.
Exactly.
Well, that brings us to the actual loan book because we have to look at what specific products these users are actually clicking on.
Right.
The lending segment is pushing some massive volume right now. They reported $711.7 million in adjusted net revenue just for lending alone.
There's a 59% increase year over year.
Yeah, 59%. And the origination volume is what really stands out here. A record $14.8 billion in total loan originations for the quarter.
The composition of that $14.8 billion is really where analysts are spending all their time today, because personal loans made up $10.7 billion of that total.
Which is a 54% jump in personal loans alone. But if you dive into the fine print, there is a structural shift happening in how they handle that debt.
Yes, there is.
Out of that $10.7 billion, they actually originated $3.1 billion on behalf of third parties through their loan platform business. They aren't just holding all this paper on their own books anymore. And they're also moving aggressively into small and medium-sized business loans right alongside home equity.
Yeah. Originating $3.1 billion for third parties is such a critical de-risking maneuver. I mean, it fundamentally changes their entire risk profile.
How so?
Well, when SoFi originates a loan and sells it, or if they originated directly for another institution, they just collect the upfront origination fee.
Right.
So they get the revenue without bloating their balance sheet with all this long-term consumer credit risk. The broader market always places a premium on fee-based capital-light revenue because it basically means the bank doesn't have to hold massive cash reserves against potential defaults.
Right. And it also frees up their capital ratio so they can just keep the origination machine running without hitting those strict regulatory ceilings.
Rightly.
But the lending engine doesn't run without fuel, which brings us to the financial services segment. This is the checking, the savings, the credit cards. They pulled in $466.3 million in net revenue here, up 29%.
Yeah.
And the massive driver for that was deposit growth. They pulled in $5.3 billion in deposits just in Q2, pushing total deposits to $45.5 billion.
Those deposits are the lifeblood of that 30% EBITDA margin we discussed earlier.
Because it's cheap money.
Exactly. By holding $45.5 billion in consumer deposits, SoFi has built an incredibly low-cost funding source. Instead of going out to institutional markets and borrowing money at like 5% or 6% to fund their loan book, they're just utilizing their own members' deposits.
Right.
So the spread between what they pay out in yield to depositors and what they charge on a personal loan is just pure net interest margin.
And beyond the net interest margin, the transactional data shows these aren't just parked funds collecting dust. The contribution margin for this segment is sitting at 46%.
Which is wild.
Yeah. Interchange fees, which is the revenue generated every single time a member swipes a SoFi debit or credit card, that jumped 55%.
Yeah.
And that is backed by $28 billion in annualized card spend. Throw in a 2.5 times increase in brokerage fee revenue, and the picture becomes very clear. Users are treating the app as their primary financial operating system.
The behavioral shift is completely evident. They are successfully transitioning users from occasional borrowers into daily active transactors.
Right.
And that daily engagement, I mean, that is the holy grail for a fintech application.
Okay, I am going to push back on the flawless narrative here, though.
Okay, let's hear it.
The consumer side of the business looks bulletproof on paper. Record revenue, optimized unit economics, massive deposit growth. But if we dig into the technology platform segment, there is a glaring 23% revenue contraction.
Yeah, that's the big red flag.
They only pulled in $84.5 million in tech revenue, and total accounts on the platform dropped 16% to $134.8 million. If SoFi is, the apex predator of fintech right now, why is their B2B enterprise segment shrinking so rapidly?
It is honestly the single biggest liability in this earnings report. The contribution margin for the tech platform plummeted from 30% all the way down to 14% this quarter.
Wow.
Yeah, and this segment is comprised of their past acquisitions like Galileo and Technisys. They basically provide the core banking ledgers, the payment processing hubs, and the risk management APIs that actually power other fintechs and consumer brands.
Right. So they are essentially trying to be the AWS of finance. They provide the cloud infrastructure and the white label APIs that allow, say, a random startup to issue debit cards.
Okay.
But the data suggests their servers are just emptying out.
Well, the broader macroeconomic environment is just incredibly hostile right now to the smaller neobanks and startups that traditionally relied on SoFi's tech stack.
Right. The funding dried up.
Exactly. Venture capital has basically dried up for Tier 2 and Tier 3 fintechs. So as those smaller companies shutter their operations or scale way back, SoFi's B2B account numbers inevitably contract. They are losing clients simply because their clients are going out of business.
Which poses a really serious valuation problem. Wall Street loves B2B software as a service revenue.
They love the SaaS multiple.
Right. It is predictable, it's recurring, and it commands a massive multiple. If SoFi can't diversify away from consumer credit risk, all the pressure falls right back onto the lending segment. So how is management actually planning to stop the bleeding here?
Well, they are executing a total restructuring of their go-to-market strategy. They've just rolled out a unified brand called SoFi Tech Solutions.
Okay.
And the strategy is to abandon the dying lower-tier fintech market and aggressively target large legacy enterprise banks. They basically want to sell comprehensive ledger and payment overhauls to massive institutions that are currently running on like 40-year-old mainframe technology.
But legacy banks are notoriously slow to rip out and replace their core ledgers. I mean, that is a multi-year sales cycle. It's a necessary pivot, sure, but it doesn't solve the immediate 23% revenue drop.
No, it doesn't. And whether this enterprise push can actually reverse the contraction is arguably the most critical storyline for you to monitor over the next 12 to 18 months.
Despite the very real issues on the B2B side, management's forward-looking statements were remarkably aggressive. CEO Anthony Noto went on record calling 2026 a defining year and a clear inflection point.
Very strong words.
Right, and raising guidance is one thing, but they're backing up that rhetoric with a very heavy product innovation pipeline.
Yeah, the innovation pipeline is entirely designed to increase that cross-buy rate we discussed earlier, pushing it well past the current 51%.
And the technology they're deploying to do that is honestly fascinating. They just launched SoFi Coach, which is an industry-first Gen AI smart financial guide. And this isn't just like a basic customer service chatbot. It is deeply integrated into the ledger. It's analyzing cash flow, categorizing spending, and autonomously nudging users towards specific financial products based on their real-time data.
It's highly personalized.
Exactly. And they also flicked the switch on SoFi Plus, moving their premium tier to a paid subscription model, and they've already crossed 200,000 paid subscribers.
See, the subscription model creates another layer of recurring capital-light revenue.
Right.
But the most disruptive technology in their pipeline is actually on the institutional side with the SoFi Exchange Network.
Right, the stablecoin project.
Yeah.
Because they currently have $300 million of their own stablecoin, SoFi USD, in circulation, and they are using this to facilitate 247 real-time money movement for commercial clients.
The mechanics of this are so vital to understand because traditional commercial banking operates on pretty archaic settlement timelines. Yeah, moving large sums of money often takes a full business day or even trade day plus 2 days to fully settle, and the networks completely shut down on weekends.
Right.
By utilizing a regulated stablecoin within their own closed-loop exchange network, SoFi allows enterprise clients to settle massive transactions instantly, like at 2 a.m. on a Sunday. For a regulated U.S. bank to successfully integrate stablecoin infrastructure at this scale is a massive regulatory and technological moat.
Because it bridges the gap between traditional finance and blockchain efficiency without exposing the client to all the typical crypto volatility.
Exactly.
All of these initiatives, the AI integration, the stablecoin settlement, the subscription tiers, they are all feeding into a much broader brand evolution. The report noted that their unaided brand awareness just hit a record 10.4%.
Which is huge. Unaided brand awareness is basically the ultimate metric for mainstream cultural penetration.
Right.
When surveyed consumers are asked to just name a financial institution off the top of their head without any multiple choice prompts, over 10% are now saying SoFi.
So they are actively shedding that old reputation of being just a niche app for medical students to refinance their loans.
Exactly.
They are muscling their way into the same mental real estate as Chase, Bank of America, and Wells Fargo.
But, stepping into the arena with legacy giants means absorbing legacy scale risks. And this is where we really have to critically analyze the forward-looking risk factors outlined in the back half of the investor presentation.
Right. The fine print always tells the real story. We have to separate that flashy 40% revenue growth from the realities of the macroeconomic environment. And management was incredibly blunt about the external threats to their model.
They were. They dedicated significant space to outlining risks tied to fluctuating inflation, volatile interest rate cycles, the implementation of announced or planned tariffs, and shifting regulatory frameworks.
Yeah.
And these are not just boilerplate warnings that lawyers make them put in. They are direct threats to the disposable income of their core user base.
Looking at it purely through a mathematical lens, any policy or economic shift that increases the cost of everyday goods, whether that's through persistent inflation or broad tariffs, it directly degrades the consumer's ability to service their debt.
Absolutely.
The SoFi member demographic traditionally skews toward high-income earners, sure, but high income often correlates with high leverage. If cost of living spikes, their ability to make payments on that massive volume of personal loans comes under immediate pressure.
Which forces us to look closely at their loss assumptions.
Right.
Management modeled this quarter under the assumption that they can keep their loan loss rates below 8%. That is a very confident projection, but we have to remember the sheer scale of their exposure here.
Yeah.
They just originated $14.8 billion in a single quarter.
And while $3.1 billion of that was offloaded to third parties, like we talked about, they are still holding a mountain of unsecured consumer debt right on their balance sheet.
It's exactly the risk. If the macroeconomic weather deteriorates and unemployment ticks up even slightly among white-collar professionals, that 8% loss rate assumption could just evaporate.
Yeah.
The record origination volume that is currently driving their 30% margin could seamlessly transition into a massive balance sheet liability. The durability of this entire business model is heavily tethered to the continued employment and financial health of the American consumer.
It sets up an incredible tension for anyone analyzing the stock right now. I mean, on one side, you have management executing the consumer strategy with just ruthless efficiency. They have essentially solved the customer acquisition problem with the FSPL flywheel.
Right, the theme park.
Right. They are locking in billions in low-cost deposits, and they are innovating with AI and blockchain settlement at a pace that legacy banks simply cannot match.
But on the other side, their B2B enterprise engine is stalling out, and they are accumulating billions in consumer credit risk right as the global economic picture grows more complex.
It leaves the retail investor with a fundamental identity crisis to untangle here. SoFi is capturing market share at an unprecedented rate. But as they take on tens of billions in traditional deposits and issue mountains of standard consumer debt, they start to look less like a nimble tech disruptor and a lot more like a highly digital traditional bank.
The ultimate question for you is whether they can actually maintain their premium tech valuation in the market, or if the sheer weight of their own loan book will eventually bind them to the slow growth, highly regulated realities of the legacy banking system they originally set out to destroy.
If you want to stay ahead of the curve on reports like this and keep mastering your portfolio, make sure to follow the show for daily earnings coverage.